Okay, Bismillahirrahmanirrahim. So now let's look at the second one, that is the cost-based transfer price. So remember, for the transfer price, we look into the first one is the negotiated transfer price. Now we look into the second one, that is the cost-based transfer price. So as the name implies, cost-based. So you are using the cost as your basis to determine the transfer price. So this one uses cost incurred by the division producing the goods as its foundation. That means the seller or the selling division. So or the producing division. And then maybe based on variable cost alone. So on what cost are you going to base it on? So you can base it on the variable cost alone, or you can use the variable cost plus the fixed cost. And then selling division may also add up markup, can result in improper transfer prices, causing loss of profitability for the company, and also unfair evaluation of division performance. This one we will look into when we do the calculation. Okay, using the same example, Alberta Company requires the division to use a transfer price. Now, you use the transfer price instead of negotiated transfer price. Now, you use the variable cost as the basis. Okay, you base on the variable cost of the sold. Now, with no excess capacity, the contribution margins per unit for the two divisions. Now, you have 10,000 units. You have boot division and sold division just now. You base on the variable cost. So for the sold division, the selling price will only be 11. Instead of 18 just now, you sell to the boot division at 11. So your cost is 11, your selling price is 11, so you make no contribution. So your contribution margin is 0. What about the boot division? So the selling price of the boot is 90 per unit. And then your variable cost excluding the sold is 35. And then the cost of the sold purchase from the sold division, this one is the 11 ringgit per unit. Remember the revenue for one division will be the cost for the other division, or the selling division, the revenue for the selling division will be the cost for the buying division. So here that will give boot division a contribution margin per unit of 44. So total contribution margin will be 44 plus 0, that gives you again 44. Okay. So what about it? So cost-based transfer price. So we can see that cost-based pricing is bad deal for sold division. So sold division is the selling division. Why? Because they are making no profit on the transfer of 10,000 units to boot division. So they are not making any profit, and they tend to lose 70,000 on their external sales. So because we assume here no excess capacity, means they are operating at full capacity, and they have all the they can sell it outside. They can sell outside at 18. But now, because the internal transfer takes place, so they can only sell at 11 because you base on the variable cost just now. So they tend to lose a profit of 70,000 on the external sales. Why? Because if they sell outside, they will get a contribution of 7. Remember, we have seen just before. That means if they sell outside, they can sell at 18. But now they have to sell inside or internal transfer. They can only get 11 because you base on the variable cost. Okay, so they can only get 11. So they tend to lose a profit of 70,000 on their external sales. That is 7 ringgit times 10,000 gives you 70,000. What about the boot division or the buying division? Of course, the buying division is very happy. Why you are happy? Because it increases the contribution margin by 6 ringgit per sold. Previously, if you purchase it from outside, you have to pay 17. You have to pay 17. Now, instead of paying 17, you only need to pay 11. So you have a savings. You have a saving. You can save by 6. So that will lead to an increase in your contribution by 6. Because if you purchase outside, you pay 17. You have the internal transfer. You only pay 11. So that contributes to your increase in the contribution by 6 per unit. Okay, so if sold division has excess capacity, the division reports a 0 profit. Now, we see if you have no excess capacity. Okay, no excess capacity. What if you have excess capacity? Again, you will report zero profit on this 10,000 units, and then boot division again will report again an increase in the contribution by 6 ringgit per unit. So overall, the company is worse off by 60,000. So if you see here, boot divisions manager, so this is great. We now earn 6 ringgit more per unit. But what about the sole division, about the seller? Here we gave up 7 ringgit contribution margin per unit and we are not making any profit. So what happened? We were earning 45 per unit and now it is only 44 ringgit per unit. That is for the company as a whole. So for the company as a whole, it is the company is worse off, and then does not reflect the division's true profitability nor provide adequate incentive for the division to control costs. So this one is the drawbacks of having the cost-based transfer price. So we have looked into the negotiated transfer price. We have looked into the cost-based transfer price. Next, we will look into the market-based transfer price. Okay. So with that, thank you very much.